In this video, you will learn how to trade Deriv synthetic indices in the market. I'll be teaching you how to trade Deriv synthetic indices, and I'll be teaching you the best synthetic indices trading strategy that you can use every day to make money from the market. And I will also be teaching you how to apply risk management to your trades. So in case you're using a small account or a big account, so you know how much you can risk on a trade when you're using this trading strategy and in general in trading synthetic indices in the market. Now, let's get to it. Alright guys, so the strategy we are going to learn today is very simple, and I use this trading strategy to trade the stable price moving indices on Deriv static indices. When I say stable price moving indices, I mean indices like the volatility indices and the jump indices. Like right now we are on jump 50, as you can see. So these are the kind of stable price moving markets that will use this Deriv synthetic indices to trade. Like for example, when you are here, you can see that the market is moving in a good way. And we also use this trading strategy to trade step index and some other indices that are moving in a good way in the market. Do not use this strategy that I'm going to teach you today to trade boom and crash, because it won't work on boom and crash. So you guys should not use it to trade boom and crash. Now, this strategy that I'm going to teach you today is very, very simple. And as you all know, we always follow the trend when we are trading our strategy. So if you are looking for an easy way to be making money in the trend, the good thing about the trend is that you will see the market moving in the trend all day. So it's not like you have to wait for a very long time. The market will be moving in a trend every single day. So it is easy for you to get a trading setup, a trend trading setup than any other setup in the market. I know some people trade with market structure. Market structure is also a good trading strategy if it follows the trend. But everything we trade is market structure. For example, when the trend is moving, it is the market that is forming a structure. So any other strategy that it is, no matter what they call it, please, if you are trading any strategy, just make sure that it is following the trend. Now, this strategy is very simple. So it's like order block. Some of you are familiar with order block, but this is not like in the concept of order block. It is not working with the concept of order block, but it's moving like the order block. Now, let me explain why. So to get this set up, the first thing you have to look out for is the trend of the market. Like if you check this out now, you can see that the market is moving in the trend. You see this, the market is moving in the trend. Now, when you see all these movements here, for example, you get this price movement here. There is something we call the base and the flip order block. Like others, what that means is that when they say the base, it means the last point of the retracement before it now moved up. So as we are in an uptrend here, this last point of the market before it moved up is the base. Now, this area where the market broke the structure is called the flip. So let's say, for example, you got a trade like this one here. Let me show you guys. So right here, you see that the market broke the structure and it stayed there. It didn't go back to this base here. This is the base and this is the flip. So it didn't go back to this base here. Now it took the orders from this point and it started going up. This is an example of a flip. But what we are going to be focused on in this strategy is the base, because the base gives you more trading opportunity than the flip. So when you are trading the base, you will get more trading entries than when you are trading with the flip. So it's better to trade with the base at all times. So when you have the market move in the base, There is a way you draw out your box. So what you do is that you draw your box from the last week points here. So it should be the lower week. That's where you draw it in an uptrend. You should draw it out from the lower week of the candle. So for example, this one here, these are the lower wicks here. If you have something like a doji here, you can see this doji here. Let's imagine we wanted to trade that doji. So we have to draw it out from the lower week of the doji. Now there are 2 weeks for that doji, but I will not draw it from this up one, because that one is it has gone too high at that point. So you draw it from this low one so that you can be able to get better trading strategy in the market. So let me delete this. So when you have seen the market break this zone here, you now draw out your box here. So when you have drawn out your box, you wait for the market to return to it. And when the market has returned to it, there are three ways that you can trade this. The first one, you can trade with a pin bar. The second one is to trade with an engulfing candle, and the third one is to trade with an with a doji candle. So the doji candle and the pin bar, they work great, and the engulfing candle too works also for this trading strategy. This is a trend following strategy, so a lot of candles work. When you are in the trend, a lot of candles, even the ones that you don't expect to work, they will work for you when you are trading the trend. But when you are going against the trend, even the best candlestick, you will find it hard to use them on the chart. Now, let me show you another example of this setup on the chart. So here we have a downtrend setup. So you can see that the market was already moving in a downtrend here. You can see the moves, the downtrend moves that is already making there. So what we are looking for now is to get our zone. So here now you can see that the market created a trend structure here. So what we are doing now is that we draw out our box. So we draw out our box here after the market has broken this structure here. You can see that the market broke this lower low. The market broke this lower low here, and then it now went back. So when it broke the lower low, if you were there, what you would do is that you draw out your box from the last candle. This is the last candle here, because this one was the highest candle for this movement here. So you draw your you draw your box on the week. So when you draw the box on the week, you wait for the market to retrace to that box. This box here, when it has retraced to this box here, then you now take your entry signal. And for this setup, you can see that the entry signal that we got is a doji candle. So you can see that after the market touched this box here, it gave us a doji candle here, and this doji candle gives us the go ahead to enter the trade. So we can now enter the trade. Let's say you are there, you enter your trade there, you place your stop loss at the top of it, and then you place your take profit target at the low here or here. Any point that you like is really your choice. So here now you can see that I am risking $15 to make $71. You can increase your risk at with any um loss size that you like that is suitable for your account. But before you trade, make sure you check your risk management before you trade, so that you don't trade what is bigger than your account. Now let me show you another example of this setup on the chart. Alright guys, so we are here on another example of this setup on the chart, and this one you can see that the market was moving in an uptrend before everything that started happening here, and now we have this uptrend structure. So we have the low, we have the high, we have the lower high, and then we have the higher high. So now, when we have this like this, when we have this, we draw out our base. So we draw our base from the last candle low. This bullish candle here was the last low of this price movement here. So we can draw out our box. When we have drawn out our box, we now wait for the market to return to this box here and give us a signal. So right here you can see that when the market return, so right here you can see that when the market return, it gave us a doji candle here. But this doji candle is a bearish doji candle and we are looking for a bullish setup. So what you do in this situation, because the doji candle, the pin bar, both of them, they are supposed to appear in bullish colors. So you don't take them immediately if you see them in a bearish state, like in a bearish color. They can have the same formation, but being bullish or bearish, they matter because they work differently in the market. So if you have a bearish doji, you wait for the market to give you a bullish candle after the bearish doji, and from there you can now take your trade from there. So you understand that. Now let's see how we risk. So let's say you enter the trade after the bullish candle, after the doji. So you place your stop loss below that doji candle. Don't place it too high. So you place your take profit target at the top there. Now, if you take this trade, you are going to make $98 with $9 risk. That is crazy, man. That's big. You are making $98 with a $9 risk. Let's imagine you risked $100. Um, um, okay. Well, let's say 1.1 ish. All right. Stop loss below it. Take profit targets here. If we traded with $100, we'll be making $1,000, bro. This is even 98. It's not even up to $1, but we are making $1,000 for this trade using a very small risk like this. So this is how the market works. This is how this trading strategy is very profitable for you. Even if you are starting with a small account, you can be able to trade them and be able to grow your account to a very big size. Don't play with this strategy, guys. This is the best synthetic indices trading strategy for trading assets that have a good price movement. Like as I told you guys, for the volatility, the jumps, and step index, and every other market that is not moving in spikes like boom and crash. If you notice that that market is not moving in crash or moving in a very funny way in the market, then you can trade this strategy with it. Now, this is very simple, and I would like to advise you when you trade this strategy, please don't risk more than you can afford to lose. Trade with a very good capital, a very good risk that you can afford to lose, guys. And follow the instruction that I just gave you guys. The instruction is the main thing. If you don't follow the instruction, there's no way that it was going to work for you if you don't follow the instruction. Now, if you want to get signals, we offer VIP signals, and there I send my trades every day in the market. You get our VIP signal trade and you make money with us, guys. So if this is your first time we're experiencing Deriv synthetic indices, all you have to do right now is sign up with our broker. The link is in the description box below. So from there you can register your account and start trading with us. Alright guys, I will see you in the next one.